Hi there, it's Brad Levin. I want to give you a brief update on the financial markets and share with you some guidance. Now, in the last video I did on February 12th, I suggested that we might have reached a bottom in the recent correction, that a recovery may be beginning from there. And so far, that has proven to be correct. The S&P 500 has gained back 60% of the loss that we experienced. However, the volatility has continued to play out. On a daily basis, the Dow Jones Index over the last month has averaged intraday moves of over 360 points day by day. That's a lot of volatility. What I also want to say is that in terms of the trend right now, the market is searching for direction, and I can't confirm a resumption of the uptrend just yet. However, if the S&P 500 is able to succeed at getting past 2,800, just 2.5% from where we are today, that'll be a very positive sign for near-term direction. Now, we talk to clients, they cite recent events, including the newly imposed tariffs, the upcoming midterm elections, the turnover at the White House, and the political environment in general as reasons to believe that the financial markets are not going to do well in the future. And what I can tell you from experience is there have been so many events historically that were expected to be very impactful that either were resolved quickly or turned out to be non-events. Right now, the fundamentals of the U.S. economy, the global economy, continue to be very robust, and that's really most important. Today, the Federal Reserve concluded their meeting for March and actually did raise interest rates a quarter point, just as investors expected, so no surprise there. They also indicated 2 more moves are likely this year in response to the robust continuing growth in the economy and also job growth. When we talk about the volatility in the markets and consider how to best respond to it, I want to share with you some of the things that we've done for clients that would be prudent guidance for anyone to consider. First of all, you want to make sure that your actual portfolio risk is consistent with your own personal risk tolerance and that's not drifted above your comfort level. For each of our individual clients, we've actually determined your own personal risk score and assigned a numerical risk score for you based on an assimilation of your expectation of return with your tolerance for risk. And actually, on an ongoing basis, we're able to check your portfolio's actual risk in contrast to the risk score and make sure the two are in sync. If you're not a client of ours, though, and you'd like to have this assessment done, you can have it done on a complimentary basis. Go to our website, www.legacywp.com, and click on the link you'll find on any page that says Free Portfolio Risk Analysis. The next thing you want to do is to make sure you're not overly concentrated in individual stocks or sectors of the market that have recently done particularly well. In our investment management discipline process, we automatically are lowering exposure to investments that have done well by harvesting those gains and redeploying them into other areas of the market. And the last year, as a simple example, we have increased exposure to foreign stocks in client portfolios in favor of cheaper values there relative to lower exposure in domestic stocks. As far as the U.S. stock market is concerned, the best performing sector recently has been technology. We have an individual stock strategy called Select Equity. And in that portfolio, as a result of gains that we have harvested, we've redeployed profits into areas of the market that were not previously performing well but are now beginning to gain momentum, specifically healthcare, energy, and most recently utilities. The last thing you want to do in terms of moderating volatility is to consider shifting your exposure slightly down in stocks and perhaps increasing it in bonds, cash, or alternative investments. Right now, good ways to protect against rising interest rates in the bond market would be to have a higher exposure to foreign bonds or also short-term bonds. These are some things that we've done in our client portfolios. You also may want to have some additional cash on hand, and you may want to have some exposure to investments that are known as alternative strategies. These are managed portfolios where the managers are trying to navigate market volatility and either mute it or profit from it using strategies designed to zig when the market zags. Now, all these things are good things to consider, but really what's most important for you is an individual decision. These are things that we've done for a lot of our clients, but I want to make sure before you pursue anything, you want to either talk to us or another professional advisor. Thanks for taking the time to listen to me today, and I look forward to sharing with you again in the very near future.